Hi, and welcome back to the Food Fund, where we explore all things related to investing in food and beverage stocks. If you are new here, our goal is to help you put your money where your mouth is and invest in great companies. If you love food and love stocks, you will definitely love this channel. In this video we will be doing an analysis of Anheuser-Busch and seeing if it would be a great addition to the Food Fund. Be sure to watch through the end of the video where I share my final thoughts on that. Now, let's go ahead and jump right in. Cue the logo. Let's start with some background info on Anheuser-Busch. Anheuser-Busch InBev was founded in 2008 through the merger of Anheuser-Busch and InBev. The company is headquartered in Leuven, Belgium, and it has operations in over 150 countries. Today it is the largest beer company in the world with a portfolio of over 500 brands, including Budweiser, Corona, Stella Artois, and Beck's. It has received a lot of media attention recently, but how does that affect the price action? Starting with the 1-year chart, we see that Anheuser-Busch had a CAGR of about 14%. Zooming out to the 5-year chart, we see that Anheuser-Busch had a CAGR of -10%. Anheuser-Busch price action has been falling for some time but has rebounded in the near term. Now, let's take a look at the fundamentals. Gross margin is 54%. Whoa, that is really high. Revenue has compounded at around 2% over the past 5 years and has reached nearly $59 billion most recently. While the gross margin is excellent, revenue growth has been very slow for some time. Looking at cash flow, we see a -4% CAGR over the last 5 years for operating cash flow, while capex has increased at a CAGR of 1%. Free cash flow has fallen at a -6% CAGR. This is very bad. Anheuser-Busch has been generating less and less cash flow for some time while capex spend has been slowly growing. This is the biggest red flag. Weighted average shares outstanding have been increasing ever so slightly, going from 2 billion shares in 2018 to 2.1 billion shares most recently. Anheuser-Busch has been slowly diluting shareholders. This is the exact opposite of what we want to see. Now let's view return on invested capital. Return on invested capital has increased from 4.9% in 2018 to 5.7% in 2023. Though the return on invested capital is fairly low, the increase over time points towards slowly improving efficiency. However, given the negative free cash flow, it seems likely that return on invested capital will suffer in the future. Another favorite metric is cash conversion cycle, a measure of operational efficiency regarding supplier and payer leverage as well as inventory control. Going from -171 days in 2018 to -188 days most recently, Anheuser-Busch has gotten a comparatively more efficient managing inventory. This value is actually pretty good. Breaking cash conversion cycle down a bit more, we see that day sales outstanding has actually been improving over time while days payables outstanding is high and increasing. Anheuser-Busch seems to have previously negotiated very favorable supplier and distributor contracts. Days inventory outstanding has been slowly growing, implying that inventory is also slowly accumulating. Very interesting. Last, let's explore Anheuser-Busch's debt. The net debt to EBITDA has been improving at a 4% CAGR, meaning net debt has been declining over time, going from 4.9 in 2018 to 4.1 most recently. The net debt to EBITDA is still pretty high but improving. The fundamentals of Anheuser-Busch are not good and have not been good for some time. However, is there some price where it should be added to the portfolio? Before sharing my final thoughts on that, please click the like button and let YouTube know that you like the content. Subscribe and click the notification bell to make sure you catch the latest videos. Your continued support means so much to the Food Fund. Now, let's get into my final thoughts. Okay, let's go to the spreadsheet and write out some key values for Anheuser-Busch. It is a beverage company with a gross margin of 54%. The 5-year revenue per share CAGR is 2% and the 5-year free cash flow per share CAGR is -6%. While the high gross margin demonstrates the strength of the company's brand value, minuscule revenue growth and free cash flow decline indicate really big problems. A return on invested capital of 6% is pretty low, but it has been increasing over time. Next, the cash conversion cycle of -188 days is really good. Concerning debt, a net debt to EBITDA of 4.1 means that Anheuser-Busch could pay off all of their debts with a little over 4 years of earnings. So from a fundamental standpoint, Anheuser-Busch isn't has been bad, with the exception of its gross margin and negative cash conversion cycle value. Now let's switch our attention over to valuation. Anheuser-Busch is undervalued relative to the S&P 500 with a ratio of 0.7. The price to earnings growth, or PEG ratio, is 1.6, which means that Anheuser-Busch is a little overvalued compared to its projected earnings growth. While Anheuser-Busch has recently received a lot of attention in the media, the brand value actually remains pretty strong, as evidenced by the high gross margin. However, the operation of the company has been poor for at least the past 5 years. In this scenario, I actually see a lot of turnaround potential for Anheuser-Busch. They will need to find a way to better control raw material costs and massively cut operational costs while maintaining quality. Perhaps it will require new leadership to execute this change. The valuation, while discounted, is still too high for me right now. This will not go on the watch list, but I will be curious to revisit this company in the future. Many thanks for watching. What do you think about Anheuser-Busch and its lack of free cash flow growth? Please share your thoughts below. It is always great to hear from you. Please check out some more videos right now and don't forget to put your money where your mouth is.